welcome everyone to our presentation today entitled The New Rage and Salt, State Pass-Through Entity Taxes. Little housekeeping here. This session is eligible for CPE. We're going to do 3 polling questions, so please respond to all of them. If you have a question during the panel, please use the Q&A box to submit that question, and we'll try to get to the questions during the session, but we will have hopefully a little time at the end to field any remaining questions. And the session is being recorded. So I'm Eugene Ruvere. I'm a state and local tax partner in Citrin Cooperman's White Plains office, and I'm joined today by Jaime Reichardt, who's a principal in our state and local tax group in the Philadelphia office. Here's our agenda for today. We're going to go through the background related to the state and local tax issues connected to the pass-through entity tax, and then we'll dig into some of the primary states that we're dealing with the pass-through entity tax, with a big focus on New York. We'll start things off with a polling question. All right, how familiar are you with the current updates on state pass-through entity taxes? The selections are very familiar, somewhat familiar, not familiar at all, or what is a state pass-through entity tax? Give everybody a little bit of time to address those. All right, and our results, good. Most of us are at least somewhat familiar with what a pass-through entity tax is. And just a couple of you out there don't know what a pass-through entity tax is. So hopefully this session is valuable to those folks. All right. So Jaime, I'm gonna pass it over to you and to go through the background.
Thanks, Eugene. Hi, everyone. So, before we get into, the impetus for these new taxes and what happened at the federal level, just taking a step back, for those that aren't as familiar, typically when we're dealing with pass-through entities, both at the federal level as well as state, right, the entity is not subject to tax, but the income flows through to shareholders, members, partners, depending on the entity type, and the individuals pay tax, whether it's at the federal level or the state and local level. Again, there's some exceptions to that. It's states that have like gross receipts tax, but in general, that's sort of the way pass-through entity tax works. Now, what happened at the federal level, which kind of changed the landscape a bit, was the Tax Cuts and Jobs Act at the end of 2017. And what that did is it put a limitation on the state and local tax deduction taken at the individual level. So for those, when we file our returns, we typically will take deductions pre the Tax Cuts and Jobs Act for property taxes, income taxes, potentially other taxes paid at the state and local level, and that used to be uncapped. Based on the changes that went into play at the end of 2017, however, that deduction, again, at the individual level, was capped at $10,000. So as you can imagine, for many states across the country, especially states with significant income taxes or significant property taxes, that limitation comes into play in a big way and really hits taxpayers in a significant way. So when the change first went into law, the first reaction I believe that states sort of dealt with or tried to enact was a mechanism which granted a tax credit for the ability to essentially make contributions to government-sponsored entities in place of property taxes. And the idea behind that was, again, to sort of find this workaround around the SALT cap deduction. And the next sort of level that came after that was the adoption of pass-through entity taxes. So when I say pass-through entity taxes, I mean the tax is actually imposed at the entity level. And the idea behind the tax, again, being imposed at the entity level is if it's imposed at the entity level, it's not subject to the state and local tax $10,000 cap at the individual level. And so the first state that really took the lead on this was Connecticut. So Connecticut came out, I believe this took effect in 2018, where they had a mandatory pass-through entity tax. So one of the things that we'll talk about over the course of our discussion today is some states have gone through what's called mandatory, where pass-through entities are subject to tax, regardless of whether or not they choose. And then most other states have gone with an elective approach, i.e. the pass-through entity has the opportunity to choose to be subject to the pass-through entity tax at the entity level to preserve these deductions. So at a high level, when we think about these pass-through entity taxes, the way that they generally work, and again, we'll dive into more detail and go through some of the differences, but the way that they generally work is the state, right, imposes a tax at the entity level, entity pays tax, and generally then there's a credit that flows through to the pass-through members, whether it's partners, members, or shareholders, when they file their personal income tax returns in those states. And the effect of the credit is essentially, it's essentially to knock out the tax that would be due at the entity level by the amount that's paid at the pass-through entity level, passed through to the individual shareholders members. So again, that's just a basic framework. We'll get into more detail, but that's kind of the basic structure of how it works. And one of the things that came up very early on as states started adopting mandatory or elective pass-through entity taxes is the IRS going to be okay with this? Especially if the tax is elected, is that going to be a good deduction? If the owners receive, like we talked about, these tax credits that they can take at the individual level in these states, is the IRS going to be okay with that? Is it going to treat it as a good deduction for a tax paid at the entity level? And in the late fall, winter of 2020, the IRS issued favorable guidance in this area, specifically IRS Notice 2020-75. And that really gave the approval for these types of pass-through entity taxes, and that the IRS will respect these deductions. And the language in the guidance says the deductions will be respected regardless of whether or not the pass-through entity tax is elective, and regardless of whether or not the individual owners, members, shareholders receive these credits. So that was really, I think, what opened the floodgates for a lot of other states to start enacting pass-through entity taxes. Next slide, please.
And just to interject real quick, Jamie, before we jump to the next slide, and you have it on the slide here, that there's probably a little bit more than a dozen states now that have enacted pass-through entity taxes. And I think there's at least 5 that have pending legislation. So it's really been kind of a bandwagon because there's a significant opportunity here. And I think from a state perspective, there's no downside, right? Except from an administrative perspective, the states are going to get the same amount of money that they always have, whether it's paid at the pass-through entity level or at the individual level. There's no real difference. They're just creating a federal benefit for individual taxpayers. So I think we're definitely seeing a lot of activity in this area with states jumping on board.
Absolutely. So moving on to the next slide. Again, so key point from the IRS notice is that regardless of whether or not the tax is elective in nature or credit is given, IRS is going to be okay with the deductions. Now, there are some considerations that come into play in terms of the wording of the guidance, where it indicates the term of art that's used in the guidance for these tax payments is called a specified income tax payment. And the specified income tax payment technically needs to be made during the tax year. So Eugene, I think this brings into play some serious considerations for accrual taxpayers, right, in terms of having to consider making the tax during the tax year. Maybe you can speak to maybe some of the financial statement implications if it's an entity level tax.
Yeah, and I think the most interesting part of that, just to go off on a tangent a little bit, is on the New York side, and we'll get into it a little bit more, but there are situations where the state in the first year of enactment is okay with the pass-through entity tax payment being made with the filing of the tax return or at the due date of the tax return, which might be in the tax year after the enactment. So we could have a situation where, and New York is the concern, that there's an October 15th election deadline for the 2021 tax year. We don't even know how to make the election yet. There's no payment mechanism yet. So we have to hope that New York and the Department of Tax gets things together to the point where we can make a pass-through entity tax payment during the 2021 tax year if the business elects into this tax regime. So it's really messy. And we saw with New Jersey last year when the IRS notice finally went through and we all felt good about electing into the New Jersey pass-through entity tax, that it was a humongous scramble and there was a lot of last minute efforts. So we can really get caught up with that in that again from a New York perspective. And maybe a last point real quick here on the cash versus accrual. For me, I mean, I'm just a state tax guy, so this is more of a federal issue as to the deductibility. But if I'm an accrual taxpayer, it really doesn't make a lot of sense that you have to make the cash payment during the tax year. That goes against the accrual-based nature of electing to use an accrual-based tax accounting method. But that's what the IRS notice implies about those specified payments. So it's a little wacky. I'm sorry, Jamie, you could jump back.
Those are great points from a practical and administrative perspective that taxpayers are going to have to consider when deciding whether or not these entities are going to make the election and pay the taxes. So just a quick summary, some of the nuanced issues we're going to be talking about in the flow of these entities, these pass-through entity taxes, is again the tax credits that are available at the individual level, composite returns. So for those that aren't familiar, that's a way that non-residents can file a group return and be included in a group return and not have to file at the individual level. There is some question as to whether or not these credits will be available on a composite return. There's also some really significant questions regarding a credit for tax paid. So when we talk about that and we have some examples, what we refer to is, let's say we're dealing with someone who is a resident of Pennsylvania, like myself, or maybe a resident of Virginia. And these states haven't provided clear guidance, or at least have somewhat indicated that they're not going to grant a credit for tax paid to residents of those states for pass-through entity taxes paid on behalf of the residents in states that have adopted these pass-through entity taxes. So again, we'll show in the example how that works from a mathematical perspective and how that might change the consideration for making the election for a pass-through entity tax.
Yeah, it could be hugely detrimental, right? The makeup of the owners of the pass-through entity, you have to think about that part of it. And as Jamie said, we have some examples in the following slides.
So we're going to start, with our deeper dive into New York. So the New York pass-through entity tax was adopted as part of New York State's budget process. Technically takes effect for tax year 2021. And generally the election is supposed to be due with the first quarterly due date, which is generally March 15. However, for tax year 2021, as Eugene referenced earlier, in light of the fact that it's new, this is brand, the forms haven't come out yet, there's really no mechanism for the election as well as for tax payment. The election is supposed to be due October 15. In addition to that, and I think it's on a later slide, individuals, right, so the members of these pass-through entities that are considering making the election, even if they will make the election, these entities, individuals should continue making estimated personal income tax payments at the individual level. That is something that the statute specifically authorizes in New York law, again, only for 2021 because the law is brand new. So again, just tying back to something that Eugene touched upon in the earlier slide, if made at the individual level, and then the entity files the return, maybe New York is going to provide some sort of mechanism for those payments to be applied on the return, maybe not, but it comes into question is how this is going to work in terms of being under the IRS guidance of the specified income tax payment needing to be made at the entity level during the tax year. So that's something that we need some more guidance coming from New York.
Yeah, there's somewhat of a, I'm sorry, Jamie, I just keep thinking about that part and that rolling around in our heads is that there's somewhat of a fear that come late December, if the mechanism's not there, do we send a payment into the void at the Department of Tax and just hope that it gets applied someplace and then we transfer or something? But it's really, we'll have to wait and see how that plays out.
Yeah, and again, just going into some of the many considerations that pass-through entities and their members are going to have to think about when considering these elections and having to pay the taxes. So once that election, and on that point, once that election is made, it's irrevocable. And once the return is filed by the pass-through entity, so that end of the year tax return, you actually cannot amend the return without authorization from the Department of Taxation. Finally, and sort of adding to the piece again, key part being entity level, once that election is made, that pass-through entity is now legally liable for that tax under the statute. So again, key point from the perspective of financial statements, if that's an entity level tax, it's liable at the entity level, it's going to potentially need to be booked from a financial statement perspective. Next slide, please. So, just like other taxes that we're used to at the personal income tax level, as we talked about, there's a estimated payment mechanism at the usual due dates that we're used to, March 15, June 15, September and December, for the estimated payments of 25%. And again, similar to other taxes that we're used to at the individual level, there's what's called a safe harbor, where essentially to avoid penalties, the pass-through entity has to make 90% of the tax paid for the tax of the taxable year, or 100% of the previous tax for the entity to avoid, again, the penalties that come up when there's a failure to make adequate estimated payments. But again, key point for this year, that's in the future. For this year, 2021, payments are still going to be made at the individual partner member level for now, until we hear more from New York. So more to come on that. Next slide. So in getting to the mechanics of how the actual taxes work and how they're imposed, there are different tax bases when it comes to the partnership entities or multi-member LLC entities versus S corporations. So at the partnership / multi-member LLC level, the tax base is comprised of essentially two pieces: the pass-through entity's non-resident New York source income, and we'll talk about what that means in a second, and then the amount of income allocated to residents of New York from everywhere, not New York source, but worldwide income. So when we think about taking a step back, for those that aren't familiar, in the personal income tax world, from a state perspective, residents pay tax on all income, non-residents pay tax on state source income. And so when this tax base is referring to is resident members of New York, resident members or shareholders that are New York residents, all worldwide income from the pass-through entity is going to be in the tax base. And for the non-residents piece, we're going to use the standard New York partnership / LLC apportionment and sourcing rules. And that essentially does an apportionment of net income using a 3-factor evenly weighted formula. So it uses the partnership property, payroll, and receipts, and you calculate a ratio from those three. So in-state property over everywhere property, in-state payroll over everywhere payroll, in-state receipts over everywhere receipts, add them together, divide by 3, and there you have your ratio that's applied to net income to calculate a non-resident state source income. Again, this is partnership or LLC level. And for sales that aren't sales of tangible property, generally, if we look to where the service is performed or where the income producing activity takes place for sourcing receipts when we're calculating that apportionment. So again, when we're dealing with partnerships or LLCs, all income allocated to residents, New York State source income allocated to non-residents using this 3-factor rule and the sourcing rules that we just talked about. Now, when it comes to S corporations, different regime. The tax base for S corporations is going to just be New York State source income. And for S corps, we use a single factor. So instead of the property and the payroll getting into the apportionment, we just look to the receipts factor. And generally, we look to, in sourcing receipts and calculating that, we look to where the benefit is received / where the customer is based for the product or service that we're dealing with.
And Jamie, before we go to the next slide, I just wanted to point out a couple situations that some of our clients experience because of the differences in how to calculate the tax base between a partnership and an S corporation for this New York pass-through entity tax, where we've had a number of clients that are sellers of tangible goods based in New York, but they ship their goods across the country. And they may thus have a 5% New York apportionment percentage when we talk about an S corporation. So in that scenario, and I'm sorry, in the example, this manufacturing company has all New York resident partners. So as an S corporation, we have to look at that 5% New York apportionment, and that is used to create the pass-through entity tax base. So they're stuck with a very low pass-through entity tax base for New York purposes, and they get very limited benefit from this tax regime. If they were a partnership, it could be totally different. They would have this scenario where, yeah, their receipts factor of the partnership apportionment percentage is low, but they're, in my example, they would all be New York resident partners. So that all of their income would be included in the New York pass-through entity tax base, and it would create a large or a larger New York pass-through entity tax liability, which thereby creates a better deduction from a federal perspective. So it's really a very markedly different result between the entity types for New York. And I don't think, Jamie, I don't think any other state has gone this direction.
No.
So we've asked questions about why New York's done it, and it sounds like there was a concern about somehow blowing the S corp election if they did it any other way. And I don't fully understand it, and certainly no other state thought it was an issue. So it is pretty unique to New York and very frustrating for some group of New York residents who happen to own S corporations that have a low New York apportionment percentage. So something, again, another consideration. Generally, it's a celebration, right? The pass-through entity tax is a great mechanism to create a federal benefit, but some folks are going to be left out just because of the nuances of the rules.
Great points. Yeah, I mean, that's the key, and we'll talk about a little bit more of that in our coming up examples, but thank you. Yeah. So again, sort of the framework of the tax, what we talked about. So the PTE owners, pass-through entity owners, when the entity makes the payment, there's a refundable credit that's available that flows through to those individuals when they go and file their own personal income tax returns for New York. And again, the way that it's supposed to be designed is to essentially try to wipe out pretty much all of the tax at the individual level from the pass-through entity that's going to be subject to New York income tax. And what the statute also provides for, which is nice, is for pass-through entity taxes imposed by other states. So for New York residents, and let's say the pass-through entity is doing business in New Jersey or Maryland or Rhode Island, Connecticut, New York is going to grant a credit for tax paid to a resident for the amount of pass-through entity tax paid by the entity on behalf of the resident to these other states that have adopted similar taxes. And that's an important clarification because, as Eugene talked about, and we'll talk about New Jersey a little more, but when we were dealing with New Jersey and was one of the first to really go live, and we're thinking about whether or not taxpayers and the entity should make the election, one of the key considerations was, is New York going to grant a credit for tax paid? And there's, different positions that can be taken based on constitutional issues and the way that the statute is written, as well as the guidance. But, from a, compliance perspective, don't want to necessarily be giving out advice in terms of there's a return position when it's not as clear that New York would grant the resident credit for tax years before 2021. So that was a welcome change. And then finally, at the individual level, to account for the credit, there's going to be an add back when you calculate your New York adjusted gross income subject to tax for the amount of the credit that essentially flows through to the individual member or shareholder to, again, calculate their tax base that's reported at the individual level.
Just to, I'm sorry, Jamie, just to emphasize the importance of that second point about the credit. And that was like the second floodgate opened, right? So the first part was the IRS kind of granting approval for the federal deduction that Jamie spoke about. But we were, in a lot of scenarios, we were held back because we weren't sure how the resident credit would work for a multi-state business. And, you know, I would say the vast majority of our clients and even all small businesses out there at this point are multi-state. So there was a huge consideration and concern about the resident credit, but now New York jumping into the regime and many other states doing the same, it opens up the opportunity for so many more taxpayers. So it's an exciting opportunity, and we're working through all the issues. But it wasn't really there last year, except for a smaller group of taxpayers. So now it's really picked up, and we're going to see a lot of activity in 2021 on this.
That's right. And the next slide just lays out the rate structure under the elective pass-through entity tax. So the rates look fairly similar to the personal income tax rates that are imposed in New York. Little slight differences, but again, starting at 6.85, going up to 10.9 for PTE taxable income over 25 mil. And again, taxable income at the pass-through entity level is going to be those different bases that we talked about, right? Different rules for partnerships and LLCs versus the S Corp regime.
Yeah, and an interesting point on the tax rates, though, is that it's cumulative, right? So all the income that's inside the pass-through entity is going to be subject to the taxes laid out on this slide. But if you had distributed that income out, your individual taxpayers who are owners of the pass-through entity, they may have been in the 6.85 bracket, or they may have been in the 9.65 bracket. So now the pass-through entity is paying in at a higher rate potentially because it's all one bucket. And when the credit gets passed out to the individual, as Jamie mentioned, there's going to be a refund, but it's still a cash flow consideration, right? We're paying in way more tax at the pass-through entity than the individuals would have paid at their level. So it's something to think about from a cash flow perspective. And there are a lot of potential cash flow issues that we'll see in some of the other states as well.
So now we have some examples. And walking through, the structure of these examples, essentially for number one, we're dealing with partnership entity. We've got a New York resident individual partner that we're looking at the tax considerations for. Again, just using a 30% federal effective rate, and all the operations of the partnership are in New York, just to show the sort of extreme differences with examples. So if you work your way through the analysis, so going to the top, we've got taxable income at the federal level before the PTE deduction of 15 million. That PTE deduction is essentially just the taxable income of the pass-through entity multiplied by the effective, the tax rate that's imposed at the pass-through entity level that Eugene just walked through. And taking that deduction, we now have taxable income at the federal level, entity level of just over 13 million. The next chain down is the distributed share that this partner has, right? So it has a 40% interest in the pass-through entity. So it's just that 13.5 million multiplied by that 40% is to get you to the partner's share of federal income. We just threw in other income for the heck of it, just to add to it. And now we've got this partner's federal taxable income at 5.9 million. And we calculated the tax due. And with that deduction that flowed through, if you calculate it at the individual level, that was essentially equivalent of a $215,000 tax benefit. So that's pretty significant when thinking about, again, the ramifications of making this election. And again, this example is a little bit, again, we're working through extremes of, partnership, all activity in New York. Next slide, please, because I think the next slide really illustrates in the example the issue of when we're dealing with a non-resident of New York, and maybe in a state that doesn't grant the credit for tax paid. So when working through this example, everything really stays the same up through federal savings to that pass-through entity owner. So that's the value of that federal deduction again, which is equal to the pass-through entity tax paid at the entity level, multiplied by the partner's share, right, of that tax. And that's the benefit for federal purposes. But here's the nuance now. If you scroll down, if you look below, in calculating at the state level, there's that line for foregone Virginia resident credit. So Virginia, in its guidance, and maybe this will change because Maryland, we'll talk about later, Maryland did adopt the pass-through entity tax. And as more guidance comes out, maybe Virginia will adjust its position. But as of now, based on current guidance, it would seem to indicate that the Virginia resident does not receive a credit for tax paid for that share of the PTE tax. So when you net the federal savings and that loss of the Virginia resident credit, you're now in a negative position, meaning it's costing the taxpayer here, this Virginia resident, it's costing them to make this pass-through entity tax election at the entity level because of the resident credit issue. So that's why it's very important when thinking about making the election and looking at all the different members and where they're residents and where they live and where the activities are. It all comes into play in terms of calculating the value of making this election at the entity level. And I did see, I'll touch upon really quick because it kind of is related. I did see a question that popped up related to California resident credit. So we're going to talk about California a little bit later because California is one of the states that actually passed legislation about 2 weeks ago to adopt a pass-through entity tax. But that legislation actually doesn't provide specifically that language for granting the credit for another PTE tax from another state. But I think the reason for that is we got pretty comfortable that under California's current guidance and statute that the resident credit should already be available for a pass-through entity tax paid on behalf of a California resident. So to answer your question, we believe, yes, the resident credit should be available. And as evidence for that, it seems that the legislation didn't need to include that language because it's already under California law and under California guidance. So in the next examples, the numbers look very much the same, but the key takeaway that we want to sort of stress and again, instead of walking through all the numbers, is this is now an S corp, right? And so to Eugene's point, the tax at the entity level is going to be dictated by the apportionment. And in this example, we said 50% receipts were New York receipts. And so that again is causing the pass-through entity tax at the entity level for New York purposes to be lower than at the partnership context because of the different way that the apportionment works of sourcing income to the state. And again, that changes if we're dealing with residents versus non-residents, because residents, if you recall, again, sorry, I apologize. That's for partnerships. S Corp world, we're just dealing with New York State source income. So no difference in terms of how the tax base is calculated, but the difference between example 3 here and the following example 4 shows the calculation of the S Corp pass-through entity tax, taking into account, again, that Virginia resident credit issue of, let's say we're dealing with an S Corp shareholder, they're a resident of Virginia, their lack of that credit is going to eliminate the benefit from the PTE tax election for that particular shareholder. So that's the point of these examples. Again, key points to take away. How is the tax calculated? Are we dealing with a partnership? Are we dealing with an S Corp? What are the members of that partnership or S Corp? Are they residents, non-residents? Where are the activities of the entity? Is it all in New York? Is it multi-state? All those things get packaged into the considerations for calculating the pass-through entity tax and whether or not it makes sense for making the election. So these examples really just serve to illustrate that. Next slide, please.
All right, polling question number 2. Of the NBA teams which played in the conference finals, which play for states that have enacted pass-through entity taxes? First answer, all of them. Second, Los Angeles Clippers. Third, Atlanta Hawks. Fourth, Milwaukee Bucks. Give folks a little bit of time to think that one through. I'll sadly admit, when Jamie put this question together and I read it, I was actually confused. And I follow basketball pretty closely, and I think I know state tax pretty well, but I still got jumbled up. Hopefully the folks in the audience will. All right, so it seems like people got a little confused also. So 44% said all of them, 38% Clippers, 8% the Hawks, and lastly 10% said the Bucks. And Jamie, what was the answer?
All of them. So, we talked about California, so Los Angeles. We haven't talked about yet some of the other states, but Georgia recently adopted it a couple of weeks ago. And Wisconsin was an early adopter back in 2019. So all of these states have imposed pass-through entity tax.
Jamie, now I'm a little confused again, but the question is which played in the conference finals, right? Didn't only the Bucks and the Suns play in the conference finals?
The Hawks played in the Eastern Conference.
Oh, yep. And I think that's where I got confused too, right? I was thinking the NBA finals and not the conference finals. See? This is why I did horrible in high school on all the multiple choice exams. Anyway, here we go.
So working our way through the next state on the list, we'll talk about New Jersey. So, we talked about some of these issues, so we'll run through a little bit about New Jersey and some of the nuances. Tax took effect, tax year 2020. Again, entity level election to be made, and the return due date March 15th or the 15th day of the third month. And that's the time for making the election as well. It's on the actual return. However, New Jersey has set up an online portal that can be accessed on the Division of Taxation's website, where an entity can go and make the election and make PTE payments. So similar to, again, a lot of the other pass-through entity taxes we're talking about, there's refundable credits that are available, right, for the individual partners, members, or shareholders. And those credits pass through, right, based on the amount of tax paid by the entity. When thinking about when we're dealing with tiered structures, right, so let's say we have a partnership or LLC that owns an interest in another partnership or LLC, or an S Corp that owns an LLC interest, let's say. New Jersey allows for each entity to make the election. So you don't have to make the election for all the entities. It can really choose whichever one. But the way that the tax works is you're still paying tax on the income as it flows through at each level, but there is a credit that flows through. But the thing is, the unique thing about the way that the credit works is it's actually not taken on the pass-through entity tax return. It's taken on, in the partnership context, it's taken on the non-resident withholding return. And in the S Corp world, it's taken on the S Corp return. So it's just a strange nuance that comes up for New Jersey when you're dealing with tiered entity structures.
Yeah, Jamie, before we go, I'm sorry, Jamie, pass to the next slide, but I'll jump in that, the tiering situation does add to the complexity on a state-by-state basis, because each state kind of has a twist to it. New York, I don't recall that we touched on it that much and how they focus in on it, where the tax base only includes the income related to individuals or those who are taxed as individuals. So if you have a lower tier entity that's owned in part by individuals and in part by other flow-through entities, the tax base is just related to the individuals. So you have to elect down here and then potentially elect at the next tier up, and the next tier up. From a New York perspective, New Jersey handles it differently. Other states, look at it another way. So it's something, again, that you have to contemplate and think through the nuances, make sure you're making the elections at the right levels to be certain that you get the most benefit that you can get out of the pass-through entity tax.
Yeah, that's a great point. And I don't think we stressed that earlier. So again, just to underscore that, again, for New York, income allocated to entity members, right? So partners, that are partnerships, LLCs, S corps, that's not in the tax base at the pass-through entity level. It's only income that's going to be allocated to individual taxpayers versus New Jersey, where the tax base includes all income. So regardless of whether or not you have an entity member or you've got an individual member or even an exempt member, quite frankly, an entity that's not even subject to tax at all, New Jersey forces the pass-through entity to pay tax on behalf of all those members. And next slide, in the tax calculation for New Jersey PTE purposes, in terms of how to calculate it, is New Jersey source income. And even though the statute doesn't necessarily support this, the Division of Taxation has taken the approach that for all entities, regardless of whether it's an S corp or a partnership or an LLC, they're going to use essentially the partnership apportionment rules, which is if you file the New Jersey 1065, it's on the Schedule NRA, and that is the schedule used for non-residents for calculating New Jersey source income from a pass-through entity. Similar to New York's rules for partnerships, that relies on three-factor, right? Property, payroll, and receipts, all lumped together, divide by 3. We get our apportionment factor that's applied to net income, and that's how we calculate the New Jersey tax base for the pass-through entity regime. And an added nuance for New Jersey is what's included in the base. So New Jersey is a little bit of an interesting state in that there's separate buckets of income categories. So New Jersey is a gross income tax, so it has one category of partnership income and S corp income and royalties and wages and all different types, and they don't allow you to net those income categories. But what this legislation did for New Jersey is it actually permitted several different types of income when it's realized through a pass-through entity to be included in the base. So not just the net income from the pass-through entity, but dividends received from the pass-through entity or through the pass-through entity, rather royalties received through the pass-through entity, interest, rents, guaranteed payments. So that's a pretty favorable taxpayer provision in terms of allowing the different categories of income to be included in that PTE tax base. Another sort of nuance that comes up again in the context of the refundable credit at the partner member level is the way that it works for an estate or trust, where the estate or trust actually has the opportunity to take the credit on its own return, or it can allocate the credit to beneficiaries. So that's some added flexibility that the statute provides. And furthermore, next slide, and the statute, again, similar to other states, lays out an estimated payment regime for 415, 615, 915, 115. For 2020, like we talked about, the state actually didn't really impose penalties and generally granted abatement where there was no estimates made because the tax was new and the mechanisms weren't really in place. An issue, again, one of the considerations, Eugene brought up cash flow issue. So one of the things that comes up for the New Jersey pass-through entity tax is non-resident withholding is still applied. So for an entity that makes the election, they have to pay this pass-through entity tax, and they also have to pay non-resident withholding. And so that can have cash flow considerations for the entity in terms of whether or not it wants to go ahead and make the election to pay this tax.
And that wasn't a one-year thing, right, Jaime? That's here to stay. So that's the double layer where on the New York side, where New York said for this 2020, 2021, keep making your estimated payments at the individual level. In the future, that will go away. New Jersey, from a non-resident perspective, you have to keep going on that. Jaime, we're actually running a little short on time, so we'll move forward.
So next slide just runs through the rate structure for the New Jersey pass-through entity tax. Again, fairly straightforward, and looking at, again, state source income is using those three factors, and then sort of where the service is performed, where the income producing activity takes place for sourcing those receipts to be able to calculate net income subject to tax. So next on the list after New Jersey is Maryland. Maryland has been an interesting one. We'll run through quick because Maryland actually passed legislation last year, and it added to the non-resident withholding statute to essentially allow this entity level tax to be paid again at the entity level. The way that the legislation was written, however, it didn't allow for both the income for residents and non-residents to be included. It was just an error in the way that the original draft was written. So as a result, there was numerous questions. The tax really couldn't be administered. Nobody really wanted to make the election. The benefit was fairly limited, right? Because if only one subset of a pass-through entity, members, shareholders are going to get the benefit from this election, how do you deal with that? How do you deal with allocating the SALT deduction at the federal level if some people had tax paid on their behalf and some didn't? So it's kind of a nightmare to think through how this actually works. However, thankfully, legislation came down, I think it was in April of this year, that fixed the issue, allowed for the tax to be imposed, both for income to non-residents as well as residents. And the tax base for the Maryland PTE is Maryland source income. And Maryland, again, uses several factors, property, payroll, sales, but uses I believe it's a triple or quadruple weighted sales factor. So there's a heavily more weighted based on where receipts are earned. And Maryland sources receipts, again, for how to compute net income subject to this Maryland tax based on a market sourcing approach. So essentially where the customer is based or where the benefit of that service or product is received is how we calculate that receipts factor for how we determine effectively the tax base. And the pass-through entity tax in the legislation also specifies that it can be made on behalf of another pass-through entity. So again, separate from like New York or what's similar to like New Jersey, the pass-through entity tax election can be made and tax can be paid on behalf of the income that's allocated to entity members, not just individual members. And the controller needs to issue some regulations on that because there's not really much detail provided. So again, similar to other taxes, we got an elective, we got an estimated payment regime. What's different about Maryland, which is different from New Jersey, right? We talked about tax exempt entities, or even like REITs in this context, where New Jersey, you got to pay the tax on their behalf. Here, you get to carve out that income from the PTE tax base. So again, we're just trying to show the little nuances of differences between how these PTE taxes are imposed. For detailed discussion, for those that practice in Maryland or have detailed Maryland operations, significant Maryland operations, Maryland issued a revised piece of guidance, Administrative Release 6. That's really lays out a lot of the detail we're talking about here in terms of how the pass-through entity tax works. And just the other point I'd bring up really quickly about Maryland is for an entity that makes the election, they can't file a composite return. So that's an administrative cost and something to think about, right? So we talked about composite return. That's that return that non-residents can file as a group that takes away the need to file at the individual level. So Maryland came out and said, sorry, can't file using composite if you make that entity election. Finally, I think we have a polling question coming up.
Polling question number 3. Which states impose a personal income tax based on modified adjusted gross income or taxable income for federal income tax purposes? The possible answers are Tennessee, New Hampshire, Pennsylvania, or none of the above. We'll give folks a few seconds to think this one through. Couple more seconds. right. 57% said none of the above. Jamie, what's the right answer on this one?
The right answer is none of the above.
Nicely done, people.
Very good.
It's a tough one.
Yeah, Tennessee, no income tax. New Hampshire has this weird just taxes, dividends, and interest. And Pennsylvania, like New Jersey, has this weird gross income concept of separate buckets of income as opposed to individuals' AGI or modified adjusted gross income. So we talked about other states. Rhode Island was another one that put an elective tax into place beginning tax year 2019, flat rate of 5.99% on Rhode Island source income, with Rhode Island source income, again, difference in tax base being based on a single factor using just the receipts factor. And again, that market sourcing approach, again, looking to where the customer is based, where that benefit is received in terms of sourcing receipts for calculating that apportionment factor. And annual election, again, is going to be made on the PTE return. Similar to other states, there's a credit available to the individual owners, members, or shareholders. There's not a lot of clarity out there yet in terms of how that credit was going to be applied on the composite return. So that needs to be fleshed out a bit. Additionally, non-resident withholding, you can take away, right? So if the entity makes the election, non-resident withholding doesn't apply for that entity for Rhode Island purposes. So that's something, again, separates Rhode Island from like a state like New Jersey, where it's going to still have that mechanism in place. Next slide. So Connecticut, we talked about a little bit earlier. That one is a little different from other states, right? Because that one was the mandatory tax regime. So that went into place in 2018. Entities don't make the election. All pass-through entities with nexus, or i.e. those that are doing business in Connecticut, have to file the return and pay the entity level tax. And for Connecticut, again, just like New York, there's a little bit of a different nuance in the tax base. So there's two sort of methods for, you have an election for computing the base, and that would be Connecticut source income for the entity. So that's, again, using a receipts factor only and sourcing those receipts based on customer location where benefit is received. Or you can do Connecticut source income, again, using those rules for non-residents and all of a resident's unsourced income in the tax base. So again, that's just some of the nuances in how the base is computed. And furthermore, the credit's a little different in that for Connecticut, instead of getting that dollar for dollar, you actually get 87.5% of the tax that's computed on your behalf at the partner shareholder level. Eugene talked about, and we talked about earlier, tiered partnerships or tiered entities. So this is one where Connecticut provided specific guidance that where you have, because it's mandatory, right? So each pass-through entity has to file and pay. Connecticut allows for an owner of a pass-through entity to take out from its income that was subject to tax at a lower pass-through entity tier. Next slide, please. We're going to jump to California. California, like we talked about 2 weeks ago, so fairly new. That was Governor Newsom signed legislation that it was a host to put different things into law, some tax credits, some sales tax benefits, and buried in the bill was this PTE tax election. So what's different for California is they put the effective date for tax years 2021 through 25, or if the SALT deduction comes back at the federal level, uncapped. So if we remove that $10,000 limitation, the California PTE tax goes away. And for purposes of the tax base, it's going to be California source income on behalf of the non-residents, right? So again, single factor, using receipts factor to apply to net income, looking to where the customer is based for sourcing those receipts. And for residents, it's all income regardless of source. So again, you apply that 9.3 tax rate on the state source income for the non-residents income piece, and that 9.3% on all income for the residents' share of that income being passed through by the pass-through entity. For difference in a little bit of the tax credit that's available at the individual level, instead of being refundable, this one can be carried forward for up to 4 years. Finally, we talked about different entities, right? So entity members, individual members. The way the legislation is currently drafted today, it suggests that an entity, a pass-through entity that has a partnership or multi-member LLC owner is not eligible actually to go ahead and make the election. So that's something that is interesting. For tax year 2021, because it's brand new, as Eugene talked about, this is one of those states that's allowing tax to be paid by the original due date of the return. So again, we'll have to see how that gets fleshed out in relation to the IRS guidance of tax needing to be paid during, the taxable year to be eligible for this PTE tax deduction. And there's an estimated payment mechanism where you've got to pay 50% of the elective tax or $1,000, whichever is greater. And you've got to do that by June 15. And if it's not done, again, this is for, I would say, for years following 2021. And if this is not done, the entity actually, so if they don't make that estimated payment, the entity actually cannot make the election to pay the pass-through entity tax. So that's an important consideration. And one of the nuances, again, kind of similar to Maryland. So Maryland came out, right, and said, pass-through entity makes the election, you don't get to file a composite return. In California, it's not clear whether or not for entities that are filing the composite return, whether or not the credit is going to be available on that composite return. And that's just because of the way that California statutes are drafted, where it says credits attributable to the entity and to the business entity. So one would think maybe that there could be a limitation that because it's a credit at the individual level, it may not be available on the composite return. That's something we need more guidance from California on. And then just moving to the next slide, we talked about some of the other states that have adopted. Arizona is a recent adopter. We talked about Georgia, the Atlanta Hawks, right? And Georgia, interesting little difference, instead of a credit, Georgia grants a subtraction from income. So when the individual goes to file their return, the income that they have that's subject to PTE tax gets removed from their tax base instead of them getting a credit. In Massachusetts, it was passed by the legislature, but the governor actually vetoed because the legislature didn't give a full dollar for dollar credit. So we need to see what happens in Mass. And Michigan's an example. Eugene talked about administrative costs. Governor vetoed the pass-through entity tax with an eye towards, the department isn't ready to administer this and it's going to be costly, and maybe they're going to bake it into a larger budget context. So that's really it from terms of these pass-through entity taxes and where they've been adopted and some of the things that have been happening. Eugene?
Yeah, and I think the last bullet on the prior slide actually is a critical point, that this could all go away, right? That the feds could make an effort to bring back the SALT deduction, and then a lot of this will fall by the wayside. And some of the states have said that if a federal change is enacted, then the pass-through entity tax goes away. So I think everyone's seen that this is a great opportunity potentially, but there's a lot of nuance to it, from apportionment to credits. There's so many things going on here that a lengthy thought process has to go into it before you elect, because you don't want to jump into something that creates possibly no benefit or maybe a negative benefit, right? The example that Jaime showed, where there was a Virginia resident related to a New York pass-through entity tax regime, and they actually, they were worse off because of the situation, because of the resident credit that was lost in Virginia. In scenarios where there are partners or members who are in no income tax states, it's pretty straightforward, right? There's not going to be a credit mechanism. So that second bullet there, that just captures that point, that it makes it a little bit more simple. We don't have to think through the credit mechanism. There's a lot of administrative costs that we have to think through, as noted in the third bullet, about added compliance costs and potentially there being no composite return. Maybe not a big deal if you're a flow-through entity with 5 partners, but if that firm, if that pass-through entity has 200 partners and now they all need to file a Maryland tax return, that's a pretty large administrative cost. So we really need to think through the benefits versus the costs related to making a pass-through entity tax election. Our contact information is at the bottom of this slide here. We're out of time, so we aren't able to address any of the questions that came in that I didn't type answers to during the session. So feel free to reach out to Jamie or me with any of those outstanding questions. Thanks so much, everyone, for joining us. Jamie, great job today. Take good care.
Thanks, everyone.